Hey all, my name is Paul Borosky and I am the owner of Quality Business Plan. All too often I have clients call me up and they've already written their business plan. The only thing that they're missing is a financial workup or the financial projections for their business plan. So in this video, what I'd like to do is walk you all through what is included in my complete financial projections only business plan offering. So let's go ahead and just dive right into it. First and foremost, I'm going to go ahead and give you all a title page. The title page will look similar to this right here. Have a date at the bottom, and if you have a logo, supply me with a logo. If not, I'll just go ahead and put a placeholder logo in there for you. The next page is going to be the table of contents. On the table of contents is going to show the reader exactly all the information that's going to be included in the financial segment of your business plan. Once we're done with that, you're going to have your funding request. The funding request is going to tell the reader how much money you're looking to raise, whether it be for your startup or your expansion. Up here, we'll just summarize what the terms are going to be for your financial request, and then down here, what I do is I break it up into a chart showing where the funds that you receive will be spent, and then below that, I give you also a chart showing the different categories in which the startup costs will be broken up into. Next page is going to be the financial projections. So for the financial projections, the first part is going to be a summary. I'm going to kind of just give a summary of what the reader is to expect in the financial projections. And then I'll give us some highlights, what the revenues are, what the costs are, and what the net profits are going to be for the next 5 years. Once that is complete, I then go into the assumptions, and the assumptions just tells the reader, what you believe or what you think is going to happen. It's the foundation for your financial projections. We're going to talk about the growth rates. We're going to talk about the variable costs are going to be, and we'll touch on the advertising costs as well in the assumptions section. Once we're done with that, then we go ahead and we start to build up to your projections. We don't just dive into the profit and loss for the next 12 months. We want to show the reader where we got these numbers from. So with that said, what I'll do is I'll show what the initial daily sales are, or what you expect your initial weekly sales to be. And then what I'll do is I'll tie in our labor costs. So we'll show, we expect to have 2 managers. We expect to have 10 employees. Whatever the labor is going to be once you open your doors, that's what we're going to go ahead and document. Once that is complete, once we have our revenues lined up and we show what our labor is going to be, then I bring in our monthly costs, the rent, the utilities. And this kind of breaks it down as to what we expect opening day or once the expansion is complete. And then again, I also do include another pie chart as well, showing the mixture of the fixed cost. From there, what we'll do is we'll then go into your profit and loss statement. And the way the profit and loss statement is broken up is I break it into quarters. So for quarter 1, then we have month 1, month 2, and month 3 for your first year, profit and loss. And then I summarize it into quarter 1. And I do the same thing for quarter 2, month 3, month 4, month 5, and then month 6, and then quarter 2. And then we go 7, 8, and 9, quarter 3. And then 10, 11, and 12 for quarter 4. I also do include a common size, which shows your revenues as percentages and your different costs as percentages of revenues. From there, what we do is I then go into profit and loss for the year 2, same strategy, quarter 1, and then we go from month 13, 14, and 15. We all do that all the way down to quarter 4, and then I summarize quarter 4 here. And then once we're done with the 24-month profit and loss, I go ahead and include an income statement for your ProForma income statement. And in the ProForma income statement, I go ahead and project your revenues and costs for the next 5 years. The balance sheet, same thing. I go ahead and project what your assets are, what your costs are going to be, and your equity positions for the next 5 years as well. And the next section is going to be the break-even analysis. The break-even analysis is going to tell the reader how much revenues you need to generate in order to break even. And then I go ahead and I put it into a nice little chart here. I include the payback period as well. The payback period just shows how long it's going to take your organization to recuperate the initial investment. In this particular example, we are going to recuperate our initial investment between year 2 and year 3. From there, we go ahead and we talk about some different financial ratios. Your financial ratios may be liquidity ratios, efficiency ratios, equity ratios, and then also your profitability ratios as well. Once that is complete, your NPV profile, it's going to go ahead and just include a brief summary of what's going on with your NPV profile. In this particular example, what I do is I increase your cost of capital 10% and decrease the cost of capital 10% just to see what happens to your net present value. Net present value is just the value of the organization based on your cash flows discounted by your cost of capital. Your cost of capital, all that is how much is it, what is your interest rate for debt? What is the return that's expected from your equity investors? I go ahead and figure out what the cost of capital is, and then we go ahead and apply it to net present value to determine how the cost of capital is going to impact the value of your organization. With that done, excuse me, I then do a sensitivity analysis as well. The sensitivity analysis will focus on cost of goods and total expenses. The whole purpose of your sensitivity analysis is to determine which cost is going to most impact your organization. Is it going to be your cost of goods, or is it going to be your operations cost? Once you're able to identify which cost is going to be most impactful to your organization, then you can go ahead and once you identify it, you can go ahead and you can build strategies to make sure that you can attempt to mitigate the losses and also exploit gains in that particular area. But in order to do that, you need to know if you need to focus more on your cost of goods or your expenses and operations. Next is going to be the scenario analysis. The scenario analysis is going to be a best case and worst case scenario analysis. For the best case scenario analysis, what I'm going to do is I'm going to bump up your revenues 15%, and I'll show you how that impacts your net profits. And then for worst case scenario, what I'm going to do is I'm going to reduce your revenues 20%. And again, I'm going to show how that's going to impact your net profits. Once that is complete, the final section is going to be your company projected valuation. The valuation of the organization is based solely on projected revenues. And that's it. I'm not using, the value of your equipment or anything like that, the value of your brand. That's not included. This is just flat out what we expect the revenues to be for your organization, discounted by the cost of capital. And the company valuation is going to be the net present value, NPV. So the NPV is the company valuation based solely on the revenues. All right, so that is everything that's going to be included in my complete financial section only aspect of a business plan. So if this is, if this works for y'all and you want me to go ahead and assist you with doing this, just pick up the phone, give me a call, send me a text, and I would be absolutely delighted to assist. Thank you.